Good morning, good afternoon, depending on where you're joining us from. Welcome everyone. Thank you so much for being here. Super excited to spend the next hour together. We'll give folks a few moments to join. Looks like the number of participants is continuing to go up. Looks like maybe we slowed down here. So we're just going to go ahead and roll right into this. We have a lot to cover. We're going to be talking about how to navigate quarterly taxes as a therapist. If you're new to private practice, having to pay quarterly taxes can feel very confusing. And so we're going to break it all down for you, explain how it all works. Important to note that April 15th, which is coming up next month, is tax day. It's when your taxes are due for last year. So your 2024 tax return, that's your personal tax return, any outstanding tax liability that you owe for 2024. It's also when your first quarterly payment is due for 2025, because of course the IRS wants all of your money at once and doesn't want to make it easy on business owners. So with that Q1 deadline coming up, now's a great time to get prepared and make sure that you make that first payment. Couple of housekeeping items. This is a larger group today, so we have disabled the chat, but the Q&A is open. We love taking questions from the live audience. It makes it a lot more fun for us. And no question is a dumb question. I will also say that if you have a question, someone else probably also has that same question. So please drop it in the Q&A. Melanie is here. She will help to moderate the Q&A, and then we'll stop throughout as well to take questions. And we'll save some time at the end. This is being recorded, so if you have to jump off early, don't worry about it. We'll email you the recording today. We'll also send you the slides, so don't feel like you need to take notes. Quick warm-up poll before we jump into the content today. I'm curious if you made quarterly tax payments last year. So I'm going to put the poll up on your screen. So you should see a poll now. Possible answer choices are yes, not every quarter, no, or I don't remember, which is totally okay. All right, so I'm going to read the responses out. You should see them. Let me hit share. That would be helpful. See them on your screen here. 64% said no. So an opportunity to make those payments this year and get ahead of it, avoid any of those IRS penalties, which we're going to talk about. 29% said yes, which is great. 6% said not every quarter. Very quickly, if you're not familiar with Herd, if this is your first time attending one of our webinars, welcome. We're so glad that you're here. Herd is financial management software built for you alongside therapists. We manage your bookkeeping on a monthly basis. We help you to estimate your quarterly taxes. So what we're talking about today, we actually provide you with an estimate, remind you when to make that payment. We also help prepare and file your annual taxes. So we're in the middle of tax season right now. We also have payroll if you are an S Corp, and we have other financial services like helping you to set up a retirement plan. And we also have really an amazing support team as well that supports you throughout the year. Very quickly here, we do offer free consultation calls. So if you're interested in learning more about Herd and getting help with all of this tax stuff, definitely encourage you to schedule a free call with our team. I mentioned that the first quarterly tax payment is due on April 15th, which we're going to talk about. In order for us to get you an estimate on what you owe for that first payment, you would need to join Herd by March 10th, which is next week. I know that's pretty quick, but should be enough time. If you're interested, schedule a call this week and be able to make a decision by next week, but absolutely no pressure. I will just clarify that this is a consultation call with a new business advisor from Herd. So this isn't a tax consultation with a CPA. Any questions that you have specific to your unique tax situation, though, definitely a great question for our support team. And then you can just pull out your phone, scan this QR code. There's a form on the page that you fill out. It takes 30 seconds. Melanie can drop that in the chat as well. Looks like you already did. Quick intros. My name is Michael. You may have seen me in your inbox. I am Michael from Herd. I host our podcast, Herd Business School. I also oversee our brand and content team here at Herd, and Melanie is with us today as well. She is our head of marketing. Quick overview of the agenda. We're going to talk about who has to pay quarterly taxes. So if you're not sure if you're required to pay them or not, we're going to clarify that. We're going to talk about why you have to pay quarterly taxes, how much to pay. This is a big one. When payments are due, and then what happens if you don't make those payments. So we're just going to roll right into it. So who has to pay quarterly taxes? The IRS guidance for who has to make quarterly estimated payments is actually pretty straightforward. If you expect to owe $1,000 or more in federal taxes at the end of the year, then the IRS requires you to make estimated payments quarterly. So in other words, if you expect to owe $1,000 in taxes, then you are expected to make payments quarterly towards that estimated tax liability. These are estimated payments. They don't need to be exact. If you overpay these estimates during the year, when you go to file your taxes and you've overpaid your tax liability, you get a tax refund. If you underestimate, then you may owe money when you file, and there may be an underpayment penalty, but it's likely pretty insignificant. So the question here is, great, how do I know if I'm going to owe $1,000 in taxes or more at the end of the year? So we're going to talk about this. So if we take a step back, why do we have to make these estimated payments quarterly? Why can't we just pay our taxes when we file at the end of the year? So when you're a W-2 employee, if you've been a W-2 employee, taxes are withheld by your employer every time they pay you. So they run payroll, they pay you your salary, they withhold taxes from your paycheck. They pay half of this 15.3%, and you're responsible for paying half of the 15.3%. Now, when you're self-employed, taxes aren't being withheld from the money that you're earning, right? So you're responsible when you're self-employed as a therapist, whether you're in private practice or working as an independent contractor, for paying federal income tax. The amount that you owe in federal income tax depends on your tax bracket, which we're going to talk about here in a moment. You owe state income tax. So depending on the state that you live, whether you have state income tax or not, and some states are higher, some are lower. But everyone who is self-employed and is taxed as a sole proprietor also owes 15.3% self-employment tax. So this covers Social Security and Medicare. Now, when you're self-employed, instead of waiting until the end and paying it all at once, the IRS wants that money 4 times at these quarterly tax deadlines. And that's likely because with employers, they're making these quarterly payroll reports. And so it's just keeping on the same schedule as employers. Also, the IRS just wants your money throughout the year. They don't want to wait until the end of the year to collect that from you. So how do we calculate how much we actually owe? So there's 2 ways to think about how to calculate how much to pay in estimated payments. And if you do one of these 2 things, you are reaching what's called safe harbor. So you're making estimated payments, and you are kind of reaching safe harbor. So the first option, and this is a good option for folks who maybe have been in private practice for a few years, their income is pretty stable. As long as you pay 100% of last year's tax liability in estimated payments for this year, or if you're a higher earner, which is defined as someone with a adjusted gross income of $150,000 or more per year, you have to pay in 110%. As long as you're paying in 100% of last year's tax liability, you're not going to pay underpayment penalties. So you're going to protect yourself from penalties. The downside of this is if you made a lot of money last year and your practice is a lot smaller this year, and then you pay the same amount that you paid last year in estimated taxes, you're going to end up overpaying in taxes, which isn't the worst thing because you get that money back, but it's also less cash you have in your pocket. The other, downside of this too is if you didn't have income from last year, then it's kind of hard. It's hard to calculate this, right? Like I wasn't in private practice last year. So those of you who work with like a CPA or an accountant, they likely provide estimated tax vouchers for you. And this is how they get to that. They may say, hey, are you expecting to earn kind of a similar amount of income for this upcoming tax year? Excuse me. Now, the other way to think about how to calculate your estimated taxes is reaching 90% of your current tax year liability. So how do you calculate what your current tax year liability is going to be? So we're going to do some math here. So stay with me. And I want to stop after this one, Melanie, to take questions. So I think it's helpful to explain this with an example, right? So in this example, you're a sole proprietor therapist. So kind of the most basic tax structure. You live in the state of Georgia. You're filing single, so not filing jointly. And you have $100,000, nice round number, in annual private practice income. Now, the reason that we provide this example here is also to show you that how much you're going to owe in taxes, it really depends on a variety of factors, right? You may have heard 30%, you may have heard 20%, you may have heard 40%. It really depends. So it depends on how you're taxed, depends on where you live, depends on how you file, and it also depends on, how much money that you earn. And so the best way to calculate how much you're going to owe in quarterly taxes is to consult with a tax professional because they're able to provide specific guidance to your unique tax situation. But if that's not a possibility, or you'd rather just try to figure it out on your own, here's how to go about doing that. So again, sole proprietor making $100,000. This is, I'm sitting down, I'm expecting or estimating to earn $100,000 for this year. So the first thing we need to think about is, before we even get into how much am I going to pay in taxes, how much money am I going to earn? So I'm expecting to earn $100,000 this upcoming year. That's my gross income, total income. But we don't pay taxes on our gross income. We pay taxes on our net income or our profit. So again, using a nice round number here, that's easy for math. We're estimating we're going to have $20,000 in expenses. And so our net income, or what's also called our taxable income, is $80,000. So we're paying taxes on $80,000, not $100,000. So how much are we going to owe in taxes on $80,000? Remember I said you owe federal tax, state tax, and self-employment tax. So our federal tax effective tax rate, and I'll explain what that means here in a second, is 15.8%. So we're expecting to owe $12,640 in federal income tax. The Georgia state tax rate is 5.49%, which comes out to just over $4,000. And then that 15.3% self-employment tax I mentioned comes out to $12,240. So our tax liability is 37%, which is quite high, at just under $30,000. So we're going to owe about $30,000 in taxes. Quick aside, I want to just talk about what is an effective tax rate for your federal income tax. So you may have heard of tax brackets. If you look at your tax bracket, it shows you how much you owe in federal income tax, what the percentage is based on your total taxable income. There's different tax brackets if you're filing single, if you're filing jointly. You may look at your tax bracket at $80,000 and say, oh, it's 22%. My federal income tax rate is 22%. But in the United States, we have what's called a progressive tax system. And so what that means is actually the first $11,600 you make gets taxed at 10%. So you would just multiply 11,600 by 10%. And then from the money that you earn from $11,600 to $47,150, and these ranges are set by the federal government, is taxed at 12%, and then it jumps up to 22%. So the money that you make that exceeds 47,150 gets taxed at 22%. So you basically take 10% of this amount, 12% of this amount, 22% of this amount. You add that all up, and that's how you get to this 12,640, which comes out to about 15.8%. So it's kind of nice you don't owe 22% on all of your income, but it's also just a little bit more complicated to figure out. All right, so our estimated tax liability, and again, this is an estimate, right? It doesn't need to be exact, is $29,272. So it's about $30,000. If we divide that number by 4, it comes out to about $7,500. So I know that if I make an estimated payment of $75,000 quarterly, I should be covered. Well, how much should I be saving every month for taxes? So to take it a step further, I'm going to take that $7,500 and I'm going to divide it by 3. So I know every month I need to be setting aside $2,500 for taxes. So at the end of the month, when I go to take money out of my bank account and, pay myself, I'm going to set $2,500 aside. I'm going to put it in a separate savings account, and I'm not even going to touch it or think about it. Because what we don't want to happen is we're not setting money aside for taxes. We're just taking money, all the money out of our business bank account, putting it into our personal account. We're spending it, and then we get to tax time, and we don't have $7,500 set aside to make this payment. We're going to talk about what happens if you don't make payments and kind of what the consequences are of doing that. Also, just to note, this is probably an overestimate. We're not accounting for things like the home office deduction, any tax credits, anything like that. So likely our tax liability will actually be much lower. But again, we'd rather be more conservative here, overestimate, get money back than underestimate, and then have like a big surprise tax bill at the end of the year. So before I jump into these questions, I wanted to just see, Melanie, if there's any questions or any thing that folks would like clarified. Again, the chat is disabled, but the Q&A is open. So if you have questions, I know that was a lot of math. I just sort of threw a lot of numbers at you. Definitely drop that in the Q&A.
Yeah, first question here is for someone that's in their first year of private practice, is 30% of my quarterly revenue a good estimate to pay for quarterly taxes?
Yeah, so like I said, in this example, it's 37%. So if you're paying in, 30% or setting aside 30%, I think it's a good rule of thumb. I would say if you wanted to be more conservative, you could set aside 35%, right? But it just depends on where you live. Like if you live in a state like Washington with no state income tax, you're not going to owe this 5.49%, right? Also, this federal tax rate is based on $80,000 in net income. So if you're expecting 30, 40,000, right? If we go back here, if you're below 47,000, your effective federal tax rate is going to be much lower. You're probably going to be more in the 20 to 25%. So um, it really just depends. But I would say in general, 30, 35% is like a good benchmark.
And then also a few questions just about what if I both am a W-2 employee, but then also a 1099 contractor through RULA, for example? How does that kind of work in this situation? Do I still need to be thinking about the lump sum of that income?
Yeah. So when we talk about your net income and calculating what you owe in taxes, we're looking at your self-employment income, right? Because your W-2 income, taxes are being withheld. So you don't have to pay quarterly taxes on your W-2 income because your taxes are already being taken out. Now, when we calculate our total tax rate, we do look at all of our income, our W-2 and 1099 income. We look at that together to see like what our federal tax rate is. But when we think about our like how much we're setting aside for taxes, we should just be looking at our self-employment income. What some people do if they have self-employment income, if they're working as an independent contractor, they'll adjust their withholdings for their W-2 job. So if you have a W-2 job, you submitted a W-9, actually W-4, excuse me, W-4 to your employer, asking about withholdings. And so you can increase your withholdings in your W-2 to cover your estimated taxes for your self-employment income. I find though it's sort of hard to know how much to increase your withholdings by, and especially if your self-employment income is variable. So that it's like one approach to it, but it's to me just seems a little bit more complicated than trying to kind of estimate out your self-employment income separately. So I generally recommend just thinking about them separately with the caveat that your total income does influence what tax bracket you're in.
Great. And then I think this first question here has come up a bit. So what if I'm an S corp? So we can jump to that as well.
Yeah, definitely. So the idea that I don't have to pay estimated payments because I'm an S corp and I run payroll is not true. So an S corp is what's called a pass-through entity, and so you're still going to owe federal and state income tax on your income from your S corp. And so you still, even though you're running payroll, you're paying payroll taxes on your salary, you still have kind of all of that pass-through income to your S corp. So you're still going to owe estimated taxes as an S corp. Right. And then filing jointly with the spouse, same thing here. I think the thing just to keep in mind is that when you think about your total combined income, it just impacts your tax bracket. So you may be in a higher tax bracket. Also, though, like filing jointly versus filing single, the tax brackets are different as well, different thresholds.
Great. And then another question here, there's actually two questions on calculating this amount. Is there such a thing as actually overpaying and then getting penalized for that? Is that like a situation you can find yourself in?
Yeah, I mentioned this. So if your employer withholds too much from your paycheck, you'll get a tax refund at the end of the year. So that's when, if you've been a W-2 employee, you use TurboTax or you work with an accountant, they file your taxes, and you get money back, right? You get like a tax rebate or tax refund. So the same thing applies here. You're just making estimated payments towards what you're estimating your tax liability to be based on your estimated income. So you're just really, you're really making your best guess. And if you overestimate, you just get that money back. There's no penalty. The downside is it's less cash flow for you during the year. If you're someone who has investments, you know, if you're basically overpaying in your estimated taxes, you basically just think of that as like you're giving the IRS a loan and then they're just giving you that money back. So you're not able to actually make any money on that money. So from that perspective, it's not helping you, but it's not hurting you either.
Okay, great. And then I'll ask one more question, then we'll save again time at the end, but this is really helpful at this stage. When we think about paying quarterly taxes throughout the year, do they all need to be equal? So does each payment need to be the same, or do you pay less now and more in Q4, for example?
Yeah, that's a great question. I'm gonna come back to that because we're gonna talk about when to pay. But I'll make a note to answer that. I would say that there's two ways to think about it. One is to calculate it per quarter and make a estimated payment based on the income from that quarter. What we recommend at Herd and the process that we use with our clients at Herd is we actually work on an annualized basis. So we look at your annual income, and then we essentially just divide that by four. Your annual tax liability, what you're going to owe in taxes based on your annual income, and we basically just divide it by four. But at each point, there's also an opportunity to re-estimate, right? Like if you thought you were going to make $50,000 this year, and then you just have like all of this growth in your business that you weren't expecting, then there's an opportunity to kind of re-estimate and recalculate um, at that next deadline. Great. So hopefully you have a better sense of how to calculate how much you owe and whether you owe quarterly taxes or not. How to make these payments is probably the easiest part of the whole process. Um, all you have to do for federal and self-employment tax is you just go to the IRS website. IRS website, direct pay is what it's called, and you can make a payment. I was looking at this morning. Just the reason for payment, you just put estimated taxes and the current tax year. You also can send in a check. If you've worked with an accountant, they may have given you like a voucher and you're able to mail in a check with a voucher. That's totally fine too. Just make sure that you keep a receipt or documentation or some sort of proof that you've made that payment. If you're in a state that has state income tax, you're also able to make these payments online. Question we get here a lot is, well, what if I work with clients in multiple states? So without getting too far down a rabbit hole here, what I will say about this is that if you see clients virtually who live in other states, depending on the state, you may be required to report that income to the state and file a state income tax return and pay state income tax in that state. Every state has their own rules on what qualifies as what's called economic nexus. And what that means is it's basically the minimum amount of money that you need to generate from a client or as a business from kind of residents of that state in order to reach what's called economic nexus and then have to report that income. It really varies by state. Some states are quite high. It's like $50,000 or more. So if it's, you have a few clients that you see in another state, likely you're not going to hit that economic nexus. If most of your caseload, for example, is in another state, it's worth checking. I recommend just reaching out to the Secretary of State or State Department of Revenue. You can just contact them through their website. Typically, there's a phone number you can call as well. All right. So I mentioned I was going to come back to this. So when do you pay quarterly taxes? You would think that it would be every 3 months, right? And so it'd be January, February, payment is in March, right? And then January, February, March, sorry, payment would be in April, and then every 3 months beyond that. It's actually not the case. So the way that it works is the first estimated payment deadline is April 15th, which is also, as I mentioned, when your tax return is due from last year. So something just to understand here is that if you didn't make estimated payments last year, you're going to owe your tax, what's called your tax liability or your tax bill on April 15th. And at the same time, you're also going to owe your first estimated payment of 2025 on the same day. And so this is another benefit of making those estimated payments during the year. So next year, when you go to file your taxes, you don't owe anything for 2025 because you've already paid through your estimated payments. And then you're able to make your first estimated payment of 2026 at that time. And so from a cash flow perspective, it just makes it a little bit easier. So the next payment deadline is June 15th, September 15th, and then you'll notice it jumps to January 15th of 2026. One way to think about this is by the first payment deadline, I should have paid 1/4 or 25% of my estimated tax liability for the year. So right now, that's just your best guess, right? Based on how much you think you're going to make this year and what your tax rate is going to be. Now, by the second payment deadline, I should have paid 50% of my tax liability for the year. So, Melanie, when you're asking about should I pay more, should I pay less? Well, there's an opportunity here to recalculate and say, like, okay, am I kind of on track with what I was expecting to make? Am I making less? Am I making more? So make that 50% payment. And then by September 15th, I should have paid 75%. And then by January 15th of next year, I should have paid 100%. Any questions about this?
I think you spoke to it, but just to kind of restate even, what if at this stage of the year I'm not exactly sure what my income will be? Do you just
Yeah.
recommend that I kind of take my best guess and then update the estimate from there?
Yeah. I would say just make your best guess. And if you underpay, that's okay. It's better to pay something than nothing. And I'm going to talk about this here in a minute because the underpayment penalty that you may owe is based on kind of what your outstanding tax liability is. And so, if you pay something, it's just going to reduce the amount that's penalized. So, if you're not sure, I would say just like pay something. Paying something is better than paying nothing. All right. So, what happens if you don't pay? So, I just alluded to this, but if you don't make these payments, if you just say, I don't want to deal with this, this sounds really complicated. I'm just going to have my accountant figure out how much I owe when I file my taxes at the end of the year. Or if you do make payments, but you just don't pay enough, or you don't pay all four payments, then you could be charged an underpayment penalty. The penalty is relatively minimal. It starts at 0.5%. So this is less than 1% of your tax liability, right? So we going back to our example, I had $100,000 in total income. I had $20,000 in expenses. So I had $80,000 in profit. I was at like about 30% tax rate, right? So I think I was owing like 27,000. So it's like less than 1% of that tax liability. Now, the longer you wait though, the more that penalty goes up, and it goes all the way up to 25%. So you're penalized for waiting longer. Also, you accrue interest on these penalties as well. And so the longer you wait, the more the penalty goes up, and then the more interest that you accrue. So definitely want to make these payments. And if you miss a deadline, just make sure that you don't wait too long in order to make them. Did I say this here? Yeah. Okay. So when we look at that $80,000 example, if you don't pay quarterly taxes, you just decide, I'm just going to wait. I'm going to pay this when I file. You're looking at a penalty, an underpayment penalty of $1,120. So that's about $1,000 to the IRS and $160 to the state of Georgia, right? So it's not a huge amount. It's not like you're paying tens of thousands of dollars in penalties and interest, but it's $1,000 to the IRS that you didn't need to pay. So we'd rather see you keep that money in your pocket. Now, if you do miss a payment deadline, you are able to apply for a penalty waiver with the IRS. And so The IRS is more lenient with newer businesses. So if it's your first year in private practice, you miss that deadline. You also have like a good history of tax compliance. You've always paid your taxes on time. The IRS may waive those penalties. That's something that you can apply for as well, but it's not guaranteed. All right, so real quick here, if you're like interested in learning more about quarterly taxes and just going deeper, I mentioned at the beginning I host our podcast at Her Business School. We had Andrew, our co-founder and CEO, on, and we just dove super deep into quarterly taxes. This is a really great episode. It's on YouTube. It's also on all podcast platforms. So if you search Heard Business School, you should be able to find it. And then again, if you're looking for support and help with quarterly taxes, this is something that we do for therapists at Herd on a quarterly basis because we manage your bookkeeping for you. So we're able to provide you, with an accurate estimate. With that said, if you're interested in getting help with this from Herd, you would just need to join by March 10th, which is next week. You can scan this code, schedule a free consultation call to meet with someone from our team. Happy to answer any questions that you have about what it looks like to work with Herd. Great, and we finished a few minutes early here, so happy to take questions. And also, again, if you have questions, please drop them in the Q&A about anything that we've discussed or just anything about kind of taxes more generally.
Great, we can start with the first question here about this year's tax date being at a similar time. So what if I paid my annual taxes for 2024? I didn't pay quarterly taxes last year. Do I also then owe for Q1 this year?
Yeah, so when you paid your annual taxes for last year, and if you didn't pay estimated taxes, when you paid, you should have, depending on how you paid, like if you just paid through, TurboTax, something like that, you should have been assessed a penalty at that time when you made that payment if you owed one. Now, you may not have owed one, but if you did, that's when you would have made that payment. There is a possibility that you owed an underpayment penalty that you didn't pay when you paid your annual taxes for last year. And in that case, then you would get a notice from the IRS. So you pay your taxes for last year, and then you might get a notice and say, hey, we received your payment, we reviewed your tax return, and we've assessed that, you still owe $300 or $500 or something like that. So you'll know, like the IRS will tell you. But yes, you would owe Q1 still at the same time if you owe taxes for last year. Is there a way to automate paying quarterly taxes if you pay the same amount every quarter? This is a good question. I think that you can set that up where it's just a kind of direct deposit quarterly. I know some people who also just pay monthly and just have these like automatic transfers go out every month. When you go to pay those estimated taxes through IRS Direct Pay, you'll notice that it doesn't specify which quarter or which payment deadline. So it's not like you're necessarily making the payment for Q1 by that date or the payment for Q2. It's more that when the IRS looks at your estimated tax payments, they look at those checkpoints, right? Of like, did you pay 25%? Did you pay 50%? Did you pay 75% and pay 100% by those deadlines? What if you haven't made the amount of income that equals your estimate based on your projected income during the first year of first quarter? Yeah, then you're probably okay here, I would say. And so if you're in this case, you're thinking like, oh, I'm going to make a lot more later in the year. I would say like as long as you're getting to that, by that next payment deadline, paying in that 50% or 75%, then that's okay. Formed a PLC PLLC, excuse me, in August of last year. I heard you do not pay quarterly taxes the first year. Is that true? If not, how do I calculate what I owe? I did not get my first paycheck for this 1099 until December 2024. So at this point, the quarterly tax payment deadlines for 2024 have passed. And so at this point, like you'll just pay whatever you owe when you file. But if you started in August, then like it just depends on what your income was. When we talk about $1,000 in tax liability, depending on your tax rate, right? If we look at like 30%, then you're looking at like $3,000 to $4,000 in taxable income is when that starts to kick in. So just to confirm, if I pay the safe harbor amount, I will not receive a penalty. That's correct. So you won't receive an underpayment penalty. Now, the thing with safe harbor, especially if you're paying last year's, based on last year's tax liability that I mentioned, is you're not going to owe an underpayment penalty. But if you made a lot less last year and you have like, much higher income this year, you're not going to pay an underpayment penalty, but your estimates are going to be pretty low. So then when you actually go to file your taxes, you might have like a huge tax bill when you file. So we generally recommend basing it on your kind of projected income from this year. So does unemployment count in 1099 total? Um, that's a great question. I'm actually not sure. I think that as a self-employed individual, you don't qualify for unemployment. I think it probably depends on the state that you're in, whether your state taxes go towards that. But that's a good question for for a CPA. I don't know. Um, I'm not sure of that one. Yeah. So a question here about federal tax rate. So I know that I went through this pretty quick, but just to review this again. So can you speak more about how to calculate the effective federal tax rate percentage? For example, how you calculate that 15% federal tax rate in the example. Yeah, so if you look up your tax bracket, or if you just look up, IRS tax brackets online, you'll see something that looks like this, right? And this is called a progressive. It's a progressive tax system, is what it's called. But if you just looked at $80,000, you might think, oh, my federal tax rate is 22%. But the way that it actually works is it's the first 11,600 that you make. So from 0 to 11,600, that amount gets taxed at 10%, right? So you just take 10% of 11,600, which is 1,160. Now from 47,150, so sorry, from 11,600 to 47,150. So you would just subtract 11,600 from 47,150. You multiply that by 12%. So you're basically just calculating like 10% of this amount, 12% of this amount, and then 22% of this amount. And that gets your total federal tax that you owe. And then you can back into what percentage that is, right? So when we actually do the math here, that comes out to 12,640, which is 15.8%. So that's how we got to this 15.8% number. What if you make 150K? I'm not understanding the question. So for your tax rate, you would just need to check the tax bracket to see like what the next kind of threshold is. Yeah, so there's a question about QBI. So QBI deduction is something that you're able to deduct when you file. So that's something that you would just work with your accountant. So you can take that into account when you're estimating here, or you can estimate your taxes without it. If you take it into account, it'll likely be a more accurate estimate, but that's just something that you'd want to work with an accountant on. So Kim asked, to confirm quarterly taxes are calculated on net income from the practice. Correct. So it's your net self-employment income. So your income after your expenses. So anything that you're not, essentially anything that you're not paying taxes on, right? Just ask if I have a personal EIN for 1099 work, do I need a separate EIN if I'm the sole therapist in my newly formed PLLC? Um, so just to clarify, so an EIN would be your, employer identification number. So that's something that you would get when you form a PLLC. I think so. If you're just a sole proprietor, you can apply for an EIN with the IRS. So if you have a PLLC, then likely, yeah, you would want to get an EIN for your specific business. Now the question is, with your 1099 work, when you provide your employer with your W-9, do you use your social security number? Do you use your EIN? Best practice would be to use your EIN, have a separate bank account set up for your PLLC, have the deposits from that 1099 go into that business bank account. Effective tax rate based on profit or gross revenue. So when we look at our effective tax rate, when we're looking at like what tax bracket we're in, we are looking at, so profit or gross revenue, this is based on your profit, right? Now, if you also have W-2 income, if you're filing jointly, you're looking at your like total income. But when you're specifically looking at, so in this example, it's like a very clean example, right? Of like, I'm a sole proprietor. I only have self-employment income. This is like all of the money that I have. Now, once you layer in W-2 income or my spouse's income, it starts to get a little bit more complex. But it would impact your, potentially your total income would impact your tax bracket. When you think about your self-employment income, you're only looking at your profit from your business, right? Because you're not paying taxes on your gross income for your business. Great question here. Can you file for a payment plan on the IRS? So what happens if you haven't paid quarterly taxes? So if you didn't pay quarterly taxes last year, you didn't set money aside for taxes, which is like totally normal. Also, life happens, life is expensive. It's hard to set aside $2,500 a month for taxes. So you go to file your taxes and you owe $10,000 or you owe $12,000 and you just don't have that money in the bank. That's totally okay. It is important to file. So there's what's called a failure to file penalty. So if you don't file your tax return by April 15th, you'll owe a failure to file penalty, or if you don't file an extension. So definitely file by April 15th, whether it's through TurboTax or working with an accountant. If you don't have the money in the bank to make a payment on your tax liability, I would say pay what you can because you're going to be charged interest, on kind of what you still owe. So if you can pay something, it's better than nothing. You also have the option to kind of apply for a payment plan with the IRS, and that just reduces the amount of interest that you get charged. So a payment plan is an option. So if I make 110,000 at my W-2 job, that's in the 24% federal tax bracket. Would my extra income from private practice and be calculated 20%? Yes. So you would look at you'd be looking at your private practice income, right? You wouldn't be looking at your total income there. Now you may owe additional kind of income tax on that W-2, but that's already being, withheld. So if you're married filed jointly, there's actually separate tax brackets. So you just want to make sure that you're looking at the married filing jointly bracket. to figure out what those percentages are. All right, this is awesome. We have a few more minutes here. Also can let folks drop off before the top of the hour. I'm sure some folks have clients here at 1 o'clock on the East Coast. Any final questions before we jump off here? I'm also going to just throw this up here again too. If you missed the link to book a call. Oh, this is a great question. Thank you, Terry. Not sure this is an appropriate question. It is appropriate. Thanks for asking. I've seen two filing deadlines, April 15th and March 17th for business filing. I am a solo part-time practice owner that is considered a pass-through entity. With that being said, I've already filed my taxes with the Schedule C. So does that mean that I can disregard the 3/17 deadline? The March 17th deadline is for S Corps to file their business tax return. So if you are an S Corp, you are required to file what's called a Form 1120S, which is your business tax return for your S Corp. And that's technically due on March 15th. But if the 15th is over a weekend, then it is due the following Monday. So that's why this year it's March 17th. So that's coming up in a couple of weeks. So if you're an S Corp, just make sure that you get your 1120S file, and that's your business tax return for your S Corp. If you're not an S Corp, you're likely a sole proprietor. And as a sole proprietor, you just owe a personal tax return. That's Form 1040. And then you'll report your private practice, your self-employment income on what's called a Schedule C, which is a form that is just submitted with your 1040. So you really just have one tax return as a sole proprietor, even though it's two forms. Whereas if you're an S corporation, you have a business tax, it's a separate business tax return, which is kind of confusing because as a sole proprietor, you're still a business owner and have business income, but the 1120S is just for S Corps. If I take extra taxes out of my W-2 job, does this cover my quarterly taxes? Yeah, so I mentioned this earlier. That is one approach. You can increase your withholdings from your W-2 job to cover your quarterly taxes from your self-employment income. The question is, well, how much do I increase it by? And it just, to me personally, feels a little bit more complicated than just looking at, okay, what am I expecting to make in my practice? How much should I be setting aside every month? And then kind of making those payments quarterly. Again, doesn't need to be exact. As long as you're kind of within the range, you're likely going to be in a good place by the end of the year. This is all about minimizing what we owe, right? Because if we don't make payments, like I said, we're going to owe a big tax bill at the end of the year, and then we're going to owe money on top of that as well. So we just want to avoid that. And if you're kind of going through that right now, if you didn't make those payments last year, kind of having that experience, now is a great time to get ahead to avoid that happening again next year. All right. Well, thank you so much. We're gonna question here. So the March 17th is just to file your 1120S for your S Corp. You can file it before, but that's just the last date that you're able to. We're going to send out the recording for this. Thank you so much for being here. Really appreciate your time and hope you have a great week.